Welcome McFinancers. I'm Drew McFinance and I'm glad you've joined us today. By listening to this video, it shows that you are interested in learning more about the stock market. This is wonderful as the stock market offers diverse options and different trading strategies that you can invest in. Now this course is designed just to help give you an introduction to the stock market and some ways you can get started today. It isn't intended to tell you how you need to invest and what you need to invest in. So here just to give you information. Now our agenda for today is we're just going to go over the basics of stocks, bonds, mutual funds, and exchange traded funds, or as everybody knows them as ETFs. Then we'll go over the portfolio allocation model, and then lastly we'll end with some next steps that you can take after this video. So stocks are the major security on the stock market. A stock is a security that represents the ownership of a fraction of the issuing corporation. That means you own a portion of that company. Companies have millions of stock depending on the size of the company. So as an owner of the company, you can get a portion of that company's profit. This is what a dividend is. Said another way, a dividend is a payout that the company gives to stockholders for owning their company's stock. This allows you to earn money from owning the stock. Now, different companies pay different dividends. So investors can get different stock to get multiple dividends from the different companies. Almost every company in the world has stocks that they sell. And some of the most popular stocks are Amazon, Tesla, Apple, and Microsoft. The other major security that is involved in the stock market is a bond. A bond is a fixed income investment that represents a loan made by an investor to a borrower, usually a corporate or governmental entity. If you have ever gotten a car or a house loan from the bank, you're going to be like the bank. You are giving your money to some entity as a loan for them to use for their business. The entity that issues the bond will give you payments for owning the bonds for X number of years. Then, as the bond expires, they'll give you your money back that you invested with them. So these companies will give you these payouts every month, quarter, or yearly, depending on how the bond is issued. So this allows you to receive consistent money that you can use in your everyday life. Now there are two examples of bonds. One is a corporate bond and the other is going to be a governmental bond. Corporate bonds are the bonds that are issued through business like Apple or McDonald's. These businesses can use those bonds to help buy new product, expand inventory, or buy a new location for a store. So then you have the governmental bonds, which can be used and issued through the local, state, or federal government. The government uses the money from these bonds to pay for new roads, infrastructure, schools, or other projects. Regardless if you get involved in governmental or corporate bonds, they both pay you consistent income that you can use for your everyday life. Then we'll move on to the next major securities in the stock market. Mutual funds and ETFs, or exchange traded funds. Now, they are both very similar. They are funds that contain either stocks, bonds, or a combination of stocks and bonds. They allow you to get better exposure to the market without owning so many different stocks because the fund owns those multitude of stocks. They both have fees for owning them that they charge their investors. Now, ETFs typically have low fees, whereas mutual funds have larger fees comparatively. The funds can have their own strategy that they follow, or they can follow certain sectors or indexes of the stock market. They could follow energy sector, so then that means they may have multiple energy stocks of different companies that help produce energy for the U.S. They could be made of bonds that provide access to multiple bonds that provide that consistent income from every month to owners. They could have these bonds from both a combination of the government and corporations, or they could specialize in more in certain types of governmental bonds or certain types of corporate bonds. Either way, ETFs and mutual funds ultimately allow investors the ability to invest into multiple securities at once and to maximize exposure when the markets are going up, but they also help minimize exposure when certain stocks are going down. Now, one of the hard parts about investing in the stock market and looking at different stocks, bonds, ETFs, and mutual funds are determining how they should be allocated in your portfolio. Now, the stock market provides a wide range of diversity and possibilities in portfolio. The stock market contains securities that follow the price of commodities, of precious metals, and even real estate. This can allow for various and diverse allocations of your stock market portfolio. Here today we're just going to talk about a investor in their 20s who are going to just invest in stocks and bonds for their retirement in their 60s. So just a note here, when we're talking about stocks, that means stocks, mutual funds, and ETFs, with just ETFs and mutual funds focusing in on different stocks. So with our investor, they're going to invest in their 20s, looking at a portfolio of 80% stocks and 20% bonds. The reason for this is because those stocks will continue growing from year to year. That'll provide large gains in money or in their investment that can eventually increase your net worth. Then we have the 20% in bonds just to help provide a little bit consistent cash flow that we can use for our everyday lives. Then, as this investor gets older, they get in their 30s, late 30s, beginning of their 50s, they're going to switch to more 70% stocks and 30% bonds. They still want those stocks to help provide more Now, the stock market provides a wide range of diversity and possibilities in your portfolio. The stock market contains securities that follow the price of commodities, of precious metals, and even real estate. This can allow for various and diverse allocations of your stock market portfolio. Today, for our allocation, we're just going to go over the scenario of an investor in their 20s who's just going to invest in stocks and bonds up until their 60s for when they retire. Now, important to know, when I say stocks, I mean it's stocks, ETFs, or mutual funds. With those mutual funds and ETFs, just kind of focusing on diverse stocks. So, our investor in their 20s and 30s will be wanting to look more at about 80% stocks and 20% bonds. We're using those stocks to help provide large gains of returns from our investments that will keep growing year after year. That will help us be able to buy more bonds when we get up to our retirement age. Then we have those bonds there just to help provide some consistent cash flow that can just provide the money to us as we need it. So then as our investor gets older, they're going to drop more from their stocks and increase more into their bonds. So they'll take some of the gains that they've gotten from their stocks, and they can help use that to buy more bonds to provide more of that consistent cash flow. So then as they keep getting older and they get up to about their 50s and then into their 60s, they're going to want to switch to about 60% stocks and 40% bonds. The reason for the 60% stock is because you still want that consistent money, or that consistent increase in your money and capital over year, but then you have the larger percent in bonds to help provide you that income, so that when you do retire, you got that consistent income that you can live off of. Now, this is just an example portfolio allocation that's been around for a long time. Nowadays, there are different portfolio allocations that people can think of, but this is just one of the basic ones. So some of the next steps that you can take is determining how the stock market can fit into your overall investment portfolio, looking at how different stocks, ETFs, mutual funds, bonds, and some of the other securities we hadn't talked about today can fit into your portfolio and for your financial goals. If you decided that the stock market does fit and that you want to pursue, you'll need to create an account that allows you to invest. We recommend Charles Schwab because we find that good customer service, good reliability, and that they provide almost every feature that you can think of when you invest in the stock market. Thirdly, we recommend that you subscribe to the Make Finances weekly newsletter to learn most about the stock market, about news, and how different events happening in the world today can affect the stock market and prices of stocks and some bonds. Then lastly, be on the lookout for any future training courses that we have to see and learn more about the stock market and how to invest in it. Thanks, y'all, and have a wonderful day.